Hey everyone, welcome back to our Demystifying Biotech series where I walk you through the tips and tricks of investing in biotech. Today we're going to talk about how different people invest in different ways when it comes to biotech. So today we're going to cover 4 key aspects of biotech investing. We're going to focus on time horizon, market cap, equities versus options, and then wrap up with value versus catalyst investing. And then I'm going to wrap up by telling you guys what my personal preference is when it comes to biotech investing. So let's start off with number 1, time horizon. There are different types of traders. There are day traders and those who hold for the long term. The key differences between these two types of investors is usually how much attention these investors want to pay towards their stocks. Day traders need to be on their game at all times, buying into positions and selling positions as quick as minutes. Long-term investors, on the other hand, may pick a few positions and hold them for 5 or more years. These investors don't typically manage their positions very often and pick secure investments that they don't have to worry about in terms of volatility and risk. The second topic we're going to talk about is market cap. First off, what is market cap? Market cap is simply the dollar value of a company. For example, if company A wanted to buy company B, they would evaluate the market cap of company B and pay that amount, or perhaps a premium. Now in biotech, market cap often is correlated with volatility. You have blue chip companies such as Pfizer or Novartis that is going to be a steady position for you without much volatility, but it's going to be limited in returns. Then you have smaller companies such as biotech companies that range anywhere between $300 million to $1 billion in market cap, which could potentially return 30, 40, 50% in only a few months or a year. Now investors have to decide what their risk tolerance is because biotech companies have a higher chance of failing. And in those situations of a biotech potentially failing a clinical trial, the share price could drop as much as 50, 60, or 70%. So evaluate your risk tolerance to decide whether you want to invest in large market cap companies or small market cap companies. The third topic we're going to talk about is options versus equities. So to put it very simply, options are contracts that allow you to buy a certain number of shares at a given price by a specific date. Because options can expire completely worthless by a given time, they're much more risky, but they also allow for a much higher return potential. If you're okay with potentially losing that sum of money you invested in options for a chance of huge returns, then options could be for you. If you rather would have a position where there is less risk unless the company goes completely bankrupt, then equities is a better option. The final aspect that I want to talk about is value versus catalyst investing in biotech. When people think about biotech, they mostly think about catalysts. For example, when a clinical trial readout goes well, a biotech stock can go up 70 to 100%. Or on the other hand, if a clinical trial readout does not go well, a biotech stock can drop as much as 50% in just minutes. Now, investors that play catalysts often are going for big returns. And when you add on options as a way to play those catalyst readouts, then those returns get magnified by 2 to 3x. On the other hand, there's an aspect of investing in biotech that's more based on value. Value investing is what Warren Buffett touts in his book, The Intelligent Investor. While many people understand how to assess value for a normal company, such as looking at PE ratios or PB ratios and such, it's a little bit more different when it comes to biotech. For biotech, you need to understand the prevalence, diagnosis, treatment rate, penetration of a drug in a market for a specific disease. All of this can boil down to tell you whether a company's market cap is cheap compared to what it should be. And this is what can drive consistent returns in biotech that's more around the 30 to 40% range rather than shooting for high-risk catalyst plays such as PDUFA dates or clinical trial readouts. So I'm going to wrap up by telling you guys how I prefer to invest in biotech. To begin, I'm shooting for pretty significant returns. So that's why I choose biotech over pharma. So small cap companies over large cap companies. Secondly, I don't like to play clinical trial readouts too much because they're incredibly high risk. And when it comes to biotech companies, they often only have 1 or 2 assets. So if a clinical trial readout goes poorly for some of these companies, there's a high chance their stock won't come up for another 2 to 3 years. Furthermore, I prefer to invest in undervalued biotech stocks over playing clinical trial readouts or PDUFA dates. The reason why is because PDUFA dates and clinical trial readouts are incredibly risky. I'd rather do a deep analytical assessment of a biotech stock so that I understand that it's undervalued, so there's potential for upside. If there's significant enough difference between what I calculate to be true value and it's currently trading at a discount, then I'll enter that position. Finally, that leads me to the time frame. I'm more of a midterm investor, so I hold my positions for 3 to 6 months, sometimes up to a year. The reason why this time frame is shorter than your typical long-term investor, but longer than a day trader, is because these undervalued biotech companies actually rally in share price pretty quickly most of the time, because a lot of other investors are looking for the same thing. You can often take advantage of these rallies and sell out of your position for 30 to 40% in about 3 to 6 months. And finally, I prefer to trade equities over options because it is just much lower risk. However, if I have high conviction on a PDUFA date or a clinical trial readout, then I will enter an options position for that biotech stock because I have assigned a higher probability of success for that stock. But in general, I prefer to invest in shares rather than in options. So that's it on my video on different people's preferences for investing in biotech. I want to hear about how you guys invest in biotech and what your preferences are. Are you a short-term holder? Are you a day trader, or are you more in it for the long run? Do you like equities or options? Leave your comments below. See you guys next time. If you guys liked our video, don't forget to like, comment, and subscribe. Also, check out our website at www.wx.capital. We have a great subscription service that allows you to get real-time trades as well as market commentary, so you know exactly what's going on with stocks and you know exactly what we're trading and what the next hot stock pick is. See you guys around.